Wuollet of Bakerson. Very excited to talk to you today. Welcome to the Capital Raiser Show. I've been wanting to get you on here for a long time. A little bit about your background, and I won't steal all your thunder, but you're the CEO of Bakerson. You've been a phenomenal operator with a good track record. Brokers know you. You've been in this business for a long time. Welcome to the show. Thank you for coming on. Tell us a little bit about your business. How about we start there?
Well, thanks for having me on. And it is. I've been kind of an under the radar, behind the scenes operator for a long time. And when I met you, you said, you got to get out there and talk to people. So that's what we're doing. And it's been really exciting. It's a great journey. So thank you.
Yeah, you bet. It's been fun. Your company was very attractive to me because I wanted to learn syndication. So I interviewed you, and you kind of turned the tables on me, and you said, well, why do you want to syndicate? You know, what is it about syndication that makes you want to do it? And I gave you a little bit about my background, but I didn't mention my father was a doctor and a real estate investor, and he left us a portfolio of properties. And I've always wanted to become successful for him and for his name, you know, to make him proud, even though he's long passed. But you did something similar with Bakerson. You actually paid homage to your grandfather or your father, who was a baker in Chicago. Tell us a little bit about how you came up with the name Bakerson and what it means to you.
It was actually in Minneapolis. I grew up in Minneapolis. I grew up in the bakery business. I worked alongside my dad, 11 years old, working 1 day a week with him, or 1 or 2 days a week, usually Saturdays. Get up at 1:30 in the morning, head off to work, get work done before the store opened at 7. So yeah, I worked alongside my dad, and that's for many years, and 15 years before I left to pursue my own dreams, my own things separate from my family business. And ultimately in 2002, I got into real estate, tax lien, foreclosures. 2003, I partnered with a good friend of mine, Jack Martin, and we were trying to figure out, now, what do we name our company? So one day I was driving down the 51 here in Phoenix, and I called him and I said, Jack, I got our company name. Actually, I said, Jack. He said, what? I said, Bakerson. He said, Bakerson. I said, yeah, that's our company name. He said, that's brilliant. My only regret is I didn't think of it first. And you see, because my dad and his dad in the 60s were bakers who worked for my grandfather at Wuollet Bakery. So Jack's dad and my dad worked alongside. And then Jack's dad, Carl, moved the family out to Seattle. And I stayed in Minneapolis, moved to Chicago, and moved down here. But I named it Bakerson because in homage of my father. At that time, he was alive. When I named it, and I told him the name of the business, he was not an emotional guy, but he did get kind of teary-eyed, and he always called me Boo. He said, thanks, Boo. He said, that was really cool. So it really touched him. So that name will stay, and in honor of him specifically. So yeah, I tell people in joking, I say, yeah, I'm an SOB. I'm a son of a baker. But I've also been a baker, still do some here and there as a hobby, but real estate's my passion, with focus on the residents. So when Jack and I got started, we actually were buying houses. I was buying houses to fix to sell. So we bought a few houses, and what I found out in that market in 2002 into 2003, from October, November, December, I found more opportunities than Jack and the team could fix. I would find them, Jack would fix them up, and then we'd find a realtor and put them on the market. And we had a partner, our money partner came in and did really well with that. So we started out bare bones at the bottom and worked our way up. In fact, at that time, I was driving a car with no AC and no heat for a year and a half as I was cruising around Phoenix, finding properties. And we found all the properties by doing a grid and driving every neighborhood in Phoenix and see a vacant house, write down the address. And we had a whole system. It was pretty fun. And so we started doing that, but I started finding more that we could sell. So I was introduced to wholesaling. And through wholesaling, we started to turn houses. But I found out that wholesaling in itself, where you sell the contract, although it's appealing and it can be fun, you lose some of the control. So what we started doing is actually taking them down, doing minor repairs, and then selling them. And we'd like cleaning the yards, things like that. Very, very minimal. No construction really, just trash outs. And at the peak, we did 287 homes in 2012. And I'll never forget, we had 7 escrows in one day at 3 different title companies, and I was like flying. It was so fun. to cruise to those places. But then because of that, those challenges, we had very new systems put in place. We decided the title company. We decided, a lot of the processes, because we had a machine with limited people. Well, through this same group of people that taught me wholesaling, I was introduced to Joel Block. And Joel looked at how we were flipping houses and said, man, you should do that in a fund. You really got to get a fund going for that. And I was reluctant. I was skeptical. It sounded Wall Street. I'm not Wall Street. I'm Main Street. I'm an operator. That's really what I am. And so after about, 6 to 9 months of discussing with Joel, my brother Mark came to me and said, hey, I got this business plan. He shared a business plan. And I said, nah, I see where you're going, but that's not where I'm going. I said, why don't you read this book? And I handed a manual. It's hundreds of pages long, Joel Block's manual. And I think I don't know if you got it. He used to do it printed out. I don't know if he still does, but I handed that to Mark. I said, you read this, and when you get done, I'll introduce you to Joel. So he read the thing, came back, said, this is awesome. This is what I want to do. So I had him call Joel, and syndications were born. And we really, really see the benefit of syndications, where you can use tools that you have, and you, I mean, me and our company have in finding properties, and then have somebody else pursue capital, and together we can form this machine that can crank out properties and profits. So that's really where we're going in this future. So we're really good at finding good deals. In fact, that is what we're great at. And developing the capital is something that we're working on, and it's really exciting to see. The friends and family is great, but after a while, our appetite is starting to surpass the friends and family network. So we're reaching out to a broader group of people, maybe even some institutions, family offices. Who knows where their journey takes us. I won't say no to anything without at least exploring the opportunities.
Yeah, that's wonderful about you. You're always open to looking at new things. It makes me nervous sometimes when I come to you with an idea, because I don't know how you're going to receive it. But so far, you've been very, very open to everything. But let's talk a little bit about your business model over the last 4 years. So you've been syndicating multifamily apartments primarily in Arizona. I believe everything has been in Arizona. But you have a specific little box or a niche of specific types of properties that you're doing. Tell us what you have been doing and if that's what you foresee for the future.
Absolutely. So our focus is the permanent renter. And a permanent renter is one who may never own a home, but would like to live in one. And those are the people that are the blue collar workers. They've got the jobs in the neighborhood. They're working in retail, working. It's not high level corporate executives by all means, but they're people that want a place to live that's safe, functional, durable, and clean. So we focus on that, and it's been classified different ways by different industries. And over time, it used to be called Class C, still called that in some circles, but the government now is moving towards workforce housing. They used to call it the working class, but then they thought, well, that wasn't a very nice term, so now it's the workforce, and that'll change, I'm sure, in the future. But it's B and C class properties. Typically 30 years old and older. I prefer concrete or block construction as much as we can. The frame wood tends to deteriorate and have other issues. We do buy those, but we really like the really durable block and brick construction. We're not afraid of properties that have issues with crime and other things, as long as the surrounding neighborhood is relatively safe. The properties that we buy, I'm willing to go there at night. I'm not afraid of going to the properties at night. And so that's the primary focus would be the permanent renter, and it's the lower income, and only so far Phoenix and Tucson, and now we've formed a partnership on a property in Texas.
So let's go into the time frame of the deals that you've been doing, because typically it's a little bit quicker turnaround. Yes, is it around between 18 and 36 months?
That's the target, is 18 to 36 months, and to get it to stabilization. And currently, everything we do, we stabilize to sell. However, we're pursuing now the concept of keeping them to hold. I know we're at a peak, so it's really easy to sell as opposed to hold. But if we get a good enough deal on a property, we'll hold it. And that would be a 10-year hold. But yeah, most of up to this date, everything we have is 18 to 36 months. Sometimes they go a little longer. Sometimes there's as short as 11 months. We had a 34 unit that was 11 months. We got an offer. It wasn't even for sale. Got an offer, and it was good enough that we accepted it and moved on to the next deal.
So tell us about the mindset behind the offering that you have for your investors, they typically come in, they invest their money up front, and then they don't see anything until the project closes, until it's the disposition time, at which point you resell it and return your money to investors. Do you find that this is a model that's been successful for you and something that you want to continue to do, or at some point do you think that you're going to shift into the concept of doing a monthly or quarterly distribution for your investors?
I want to do a hybrid. I'd like to have it where the first 12 months there's no distributions, but then there'd be either monthly or quarterly thereafter. Whether it's a 2-year, 24-month, or a 5 or 10-year hold, it would that we would begin distributions after month 12. And the reason is the investors to this date have been patient on that, the distributions. However, I believe we could cast a broader net and get more people interested. And it would also make the current investors more comfortable, because once you get to the 18-month, they do start to reach out and wonder what's going on. They might drive by the property if they're local, and they get a little bit concerned if it goes too long without feedback. So one way to communicate is to send them a check, right? So that is our goal, or my goal, month 13 on forward, that we would have distributions. And what that also does is that puts a little bit of a little pressure on us to perform quickly. And that'd be really nice for everybody in the company if we did that, because then nothing gets kicked down or pushed down the street to a future date. We deal with it here and now, get it up and stabilized in 12 months if we can, and begin distributions. However, if we have one that doesn't fit that, we'll let you know. We'll say, no, this is 18 months. But yeah, once we get beyond 18 months, the investors do check in more frequently. They want to see how their capital is doing. They want to make sure it's safe and they're going to get it back. So
we wanted to align as best as possible, in which case you recommended that I go and pay a visit and go to Joel Block's Syndication and Hedge Fund Symposium, which I did. And he told me a couple of stories, right? So I'm going to share one. He said that you came out to his event and liked what you saw, but then he didn't hear from you for a whole year. So he reaches back out to you and says, you know, this syndication model would be awesome for you. How come you haven't done it? And you told him basically that you had a better vision, that you could make money doing a different strategy. So he said, why don't you send me your financials? And then you basically showed him how much you were paying out on your money, right? So 12% plus points. And then you're doing that multiple times over a period of a year, in which case he broke it down in terms of annual percentage rate and said, look at how much you're paying for your money. At that point, you kind of had a light bulb strike and say, yeah, I'm paying way too much for my money. But really where I want to go with this is he explained syndication to you, and you've been flipping houses for a while. So this process, this shift from going to house flipper to syndicator, what was that like for you? And how did you do your very first syndication? Where did you start?
Okay, it's been about 5 years ago, so it's become almost cruise control setting them up. So the first one, when I first sent him that document, and it wasn't, he said it was 12% plus points. It was actually a profit split, and it wasn't a loan, but we did a profit split. We'd partner with one investor per property, and we would sell the property. And then some of those were getting 100% annualized return, because we would average hold time on our property was 52 days. So they could turn it up to, 7 times a year? I think was what some of them were flipping as often as 7 times a year, which is awesome, right?
Yeah.
So when you turn the money 7 times in a year, and they're getting a small percentage of the profit, or a third of the profit, but the annualized return on their money was huge. And Joel was just saying, hey, you could do the same thing with the syndication. So we got in the syndication, and the mindset was, well, we'll do this, but we got to go find a whole new group of investors, because these investors are used to these cushy paychecks and paydays that they're not going to be interested. But lo and behold, they were the first ones to fund our business. So they seen where we were going. They seen that we were growing up, so to speak. So the fund was there. But I am most excited about a syndication model, one-off, one fund per property, or one syndication per property. And it just having to share that one story with the investor and sell that particular project seems to be a better fit for our model going forward, as opposed to selling the concept of flipping houses, which we did very well. But when the market turned, we had to shift into something else. We started flipping multifamily. We did a mobile home park. We did a motel in Tempe. That was a fun one. And we thought, hey, these guys are making good money on these apartments, fixing it. We can do that through the syndication because we already understood a syndication. And that's the first one we did was Toscano Apartments in Glendale, the first full syndication.
So the Toscano Apartments, we've talked to a few people. You purchased that, you made a good profit, and then you flipped it to, or not you flipped it, but you sold it to another investor who also made a great deal of money. And then they sold it to another person. And both of these guys that are down the road are now interested in investing with us again.
Yeah, well, they've seen, we're not greedy people, so we do leave money on the table, or as they say, we leave meat on the bone. I remember that one property we sold in Tucson as well, Blackledge Flats, was 34 units, and the owner bought it, and right away he was able to get $250 more, not right away, but he was able to get $250 more rent per month because he was catering to the university, which is only 1.5 miles south of this property. So it was close enough that he could get, I'm sorry, north, university 1.5 miles south of the property. So he could get attract that because it was on the CAT tram, which is the bus system for University of Arizona. So he was able to capitalize on that. And I said, that's awesome. So then he had asked the broker that what other properties do they have in that area, which we didn't have any, but if we would have, he would have bought them because he's seen the vision. We did well with what we did. We took all the evap coolers off and put AC units. We updated the insides a little bit, redid the parking lot and the landscaping, the paint, and we got done. And the hard work, heavy lifting was done. And he did the property management lift, which is pretty remarkable to see. And I'm like, that's awesome. I'd like to sell him another property because his is worth a lot more than he paid for it. So I like to see when the buyers buy it and they make a profit from us on our properties. I don't want them to lose money and feel like we took advantage or they bought a bad deal or anything like that. I never want that to happen. I want everybody that buys from us to think, hey, that was a good experience. We made good money on this. Let's do it again.
So currently, Bakerson is exploring different ways to work with people. Obviously, a limited partner would be the ideal investor to come on board with us. But like you said earlier, Bakerson's not greedy. We like to share the profits. And in the concept and in the direction that we're going, where we're scaling, right? So we're growing as fast as big as we can with the objective to purchase as many apartment complexes as possible without mentioning the specific goal. But what I want to ask you is, what are some of the different ways, if you're going to share the profits with people and grow your business, what are some of the different ways that people can work with you as limited partner, and what else?
Well, yeah, limited partner, if people don't know, a limited partner puts money in and they're not involved in the operations at all. In fact, they wouldn't even decide on paint color. If they have ideas and opinions, you would just nod your head and say thank you, but you wouldn't let them be involved in the operations because they're limited partners. They don't have a right to that part of the process. However, there's individuals that we've partnered with that were coming in as an LP, but then they brought in a significant amount of capital. They brought in some expertise, and we ended up forming a co-GP with them. So they could come in as a general partner with some rights to what we do at the property. One of them, but then for that, they would sign off on loan docs, they would sign off on responsibilities, they'd be involved that way too. So so it's been very, very successful in that as well with a couple of partners that way.
So then for somebody who is interested in co-GPing with you, there's some things that you'll do and there's some things that you won't do. What is attractive and what's something that there's no way I would never work in that situation?
As far as the relationship or the individual or what?
The deal. So I come to you and say, hey, I have $1 million. I would like to potentially, I can't find a deal, Bruce, but you're finding deals all over the place. I'd like to work with you. If I want a specific amount of control, is that something that you'll accept? Or do you basically want me to hand over the money to you, take a back seat, and watch you operate? In what cases will that work?
Okay, and the areas that we would not want influence, and we'd have influence, but we wouldn't want to be overpowered is our vision. Like I said in the beginning, we focus on the permanent resident because our passion is serving the underserved, and our mission is creating communities which are safe, functional, durable, and clean. And there's individuals out there that are good people but they want to displace the residents. They want to upgrade the property. Say, hey, really needed to get this into a B plus or an A minus, where the neighborhood wouldn't support it or may not support it, or we're displacing residents. I even have a saying written on my board over on the wall that says, we do not hurt those we're trying to help. There's nothing wrong with gentrification. If people want to tear down a building and build a high rise and cater to the upper class or the upper middle class or even the wealthy, that's great. I don't have that vision. And so I wouldn't go into their business and tell them, hey, instead of doing that, why don't you not build that building? Why don't you just keep it where it is? No, that's their vision. It's awesome that they do gentrification. That's just not my vision. So that's one area where we would have issues. And we have at times with partners had to have a sit down to understand that we do have a shared vision, but we want the front seat on the vision. As far as the operations, the management of the property management, if somebody says, hey, I've got experience managing vertically integrated 10,000 units, I've sold them all, I've got some capital, I'd like to help you. Trust me, property management's an area where we've had some growing pains. We've ended up had it in-house for a while and decided, we're going to hire a third party. And sometimes you have to go through quite a few individuals to find the right person. And so if somebody came in and said, hey, I got some property management ideas that are really good, or I've got some marketing ideas as far as attracting residents and they could get involved that way. Or maybe they're a high level financials and they could work with Greg and streamlining the financial systems, because we're good operators, but we know that there's always areas to learn. There's always a bottleneck in the business.
What about in terms of expansion into new markets? What are some of the growing pains or the obstacles that you foresee for moving into a new market?
Well, one of the things is that one of the opportunities that we're in contract on and we're moving towards close, we are taking a back seat to somebody else's dream. We're coming in as the asset managers and we're overseeing it and bringing in some of the capital. And so that is a unique spot for me to be. Greg is our asset manager and he's going to manage that. So I said, hey, we want to give this a try, but I'm not going to be involved in the asset management. I'll work on the vision of the property with the other owners. But we are taking a back seat to the vision and operations. So sometimes that's one of the challenges of going to another market. The other thing is I won't go into another market if we don't have boots on the ground. I will not be an absentee owner that has somebody that you don't know that you just met to manage the property. You vetted them and then you give them full control. And then 6 months later, you go decide to take a surprise visit and find out that it's not 90% full. The books have been cooked or the issues are real or the city's been called. We looked at a property that we were wanting to buy in Texas where what was on the books and what was really there didn't match. It was insane what happened there. I mean, it was a slumlord situation. So that's why you need boots on the ground. That's probably the biggest limitation is finding somebody on the ground that trust and can get in business with.
Now, in regards to your business, Bruce, what is your role in the company? What is it that you do in day-to-day operations?
My primary responsibility is creating vision, creating vision and direction, determining which properties we do buy. I do walk all the properties that we put into contract. I physically walk all of them, take in all the senses, because when you're there, you hear what's going on, you see it, you smell it, you kind of get a feel for the area. So that's important to me. So I do get involved in that part of it. I make sure all the documents are put together in the right way. The capital stack is profitable. Other people do create it, but I approve them and oversee them. And then I also I do speak to each of the investors that are going to come on board personally, and that's a requirement I have because we have what's called requirements to be a Bakerson, and I'm sure you've heard these before many times. So there's 7 requirements. You should have an interest in real estate, cannot have uncontrolled ego, cannot have uncontrolled greed, must be implicitly trustworthy, must be competent at what you do, must care about people, and number 7 is why I have to talk to everyone, and we have to like you. Because we don't like each other, why do business? There's too many opportunities out there for people to fight during the process. And I figure, if we can't get along, let's just end it early. We'll go find some other capital. So
walk me through that conversation. I find somebody that says, yeah, I'm interested in working with you. So I put them in contact with you. They get on the phone with you. What do you ask them? What do you say? What do you make sure of?
Well, one of the first things we want to ask is what is their experience in real estate? Not that they have to have experience, boots on the ground, but what have they invested in? If they've only invested in the stock market or in commodities and getting into real estate, the education process is a little bit different, right? So you ought to find out what is their level of expertise in investing in real estate, and then what do they know about multifamily, and then what do they know about workforce multifamily? One individual I spoke to, I was talking to him when we were in Chicago for that conference, and he said, those kind of areas that high crime, if there's high crime, that scares me. And I said, well, don't worry, we deal with that. That your money's not going to get murdered. Your money's not going to get assaulted or beat up. The money is in the investment, but it's not so scary that I won't go there at night. But there's going to be things that happen. So people get uncomfortable with that. But then one of the most important questions that I feel is, how did you make your money? People that have an investment, it's good to know. It's a good conversation piece. It also shows their level of competence. If they're somebody that built a business and sold it, that's great. That's a good potential investor. They understand business. They understand that you have projections, and then you have reality. And your projections, your model is broken the day you open the day you close on the property. Your model is broken, because once you get inside, it's never exactly as it is. That's why we have contingencies and other things to protect us in creating our financial and business models. So those are the primary things to get in there. And also probably find out their personality. What do they like? What do they not like? What's their form of communication? Are they verbal or nonverbal? Do they like the written word? Do they prefer conversations? Things like that are important to get up front. And I know that because I didn't used to do that. And I assumed everybody wanted an email. I find out that a lot of people like to get phone calls. Well, I'm not a big phone guy. I will make phone calls, but I much prefer a quick text or an email with an update. And I'll send an update and they'll call me. And I'm like, let's talk about this update you just sent me. Like, what is there to talk about? That's kind of how I think. So it's good for us. And that's one of the reasons why we're working with you, is to help facilitate that, make sure we're making good decisions on how we communicate with people and how we vet them. We expect them to vet us, but we also want to vet the investors.
All right. So you know that I've been traveling like a madman. I've been to probably 5 cities this last month. And a lot of people, when they find out that I'm from Phoenix, they say, oh my God, that market is so hot. Everybody's doing syndication out there. And then, we're not doing syndication in Phoenix. Tell me about, what do you see going on in Phoenix, and why do you think there's such a perception that it's such an incredibly hot market here in town?
Wow, that could be a long conversation, because 3 years ago, I was frustrated that our model was broken. We couldn't get anything to pencil. And did you know that those properties we looked at, 100% of them, we could have bought them at list and made a lot of money because of the market. That the market here it went straight up, right? So we did not foresee that. We just know what we know. And people were like, there's a bubble, there's a bubble. Well, I didn't think there was a bubble, but I knew that the margins were slim. So we went down to Tucson and started buying there. We're like, man, these properties are inexpensive and we're really good price. And then the broker tells us, this will be the end of that. And we're like, yeah, whatever. We're going to buy down here until everything is bought up. 3 years later, the same problem in Tucson. So tertiary markets are getting hit. We're still seeing in Phoenix the market going up. The margins are thin, but there's a lot of different ways in a large city where you can make some changes. You can change the demographics of the residents. You could push them you could offer some amenities. You could charge for amenities. You can charge for parking. You could charge for covered parking. You could charge for community-wide Wi-Fi. You can get cable TV for the community and charge for that. People have a hookup charge. There's many different ways in a bigger city a nicer area where you can get involved in that. I don't do those, but I can see where that's a big opportunity in Phoenix. So what's going to happen in Phoenix? It's been a boom or a bust town since its inception, I think, or since it became a place to be, in the 50s or 60s when people started moving here en masse. And it continues to grow. The sun climates are very, very attractive. The economy here has been good. I do feel like Class A might be slightly overbuilt, but they said that the demand is about 150,000 units over the next 10 years. So that's 15,000 units, rental units, apartment units are going to be needed, according to the economist with the, now I forgot which, that might have been from CBRE. But anyway, 150,000 units in 10 years, that's 15,000 a year. Well, this year it looks like we're on pace to do 9,000 rental units in. But the challenge we have is they're building Class A, but the demand is in B and C. You can't build new B and C. So how are we going to attack that? Those are the questions that I don't have the answers to. So I thought, you know what? I'm going to go with what I know and stick with what I know. And I'm going to watch what's going on in my own backyard. We'll see the market plateau. People will leave from here. They'll go do that, chase the next dream, next opportunity. And then I'll get back involved in Phoenix again. But until then, until I see the right opportunity, which maybe it's tax credits for new construction for the lower income, that might be a way a guy can get involved. Because they're not going to build a building for lower income unless there's some benefit, because the cost to build, you're buying Class C at $60 a foot, and it costs you $130 a foot to build it or more. So you do the math, and you're not going to rent out $700 a month for new construction and make money on it. It's not possible. So
how big of an apartment complex do you foresee wanting to invest in as a syndicator going forward? You're currently in the, let's say, 75 to 125 unit range. Do you foresee that number getting up into the 200 unit range, or do you want to stick to what you currently do? Is your model going to change? Or are you going to stick with it?
We started out we did buy a 120 and a 64 unit, 18, 16, 22, 32, 34, 51. I think I got them all. But those units that were the buildings we bought, we found out that up until 75 units, it's a lot of work, and the margins were good, but the amount of effort, it felt like the 75 to 100 it was a good niche to carve into. The challenge, because the benefit there is that if you got a property in Tucson, for example, and somebody from California is a first-time buyer, I don't think they're going to fly to Phoenix to buy a 75 unit building, or Tucson to buy a 75 unit building. Would they come to Phoenix? Probably, but Tucson, they may or may not. And it's too large for most of the mom and pop operations. They like the 50 units and under. So it seems to be, at least in the Tucson market, where we were able to carve that out. So that's what we've done. We've done well. But we have built models, and we have made offers on properties over 300 units. I think 250 to 300 is really the sweet spot for efficiency. The staff on hand, you got a property on-site manager, you got a leasing agent, a couple of maintenance people. 250 to 300 is the sweet spot for maximum efficiency, and that's not my experience. That's not just my experience. It's just what we've seen in the marketplace and what other brokers have told us and other operators. They said that under 250 units, you start to lose some efficiencies. So that's my long answer to yes, we're going to pursue 150 to 300 unit buildings going forward, and we have made offers on some, and we've been outbid.
So walk us through, you currently have a deal down in Tucson. Give us some details about it. I don't want to talk about it as much as give you the opportunity to tell us more about the deal. Okay,
the property in Tucson is a 90-unit apartment building, and I like to tease that it's a tower. We call it's Bellevue Tower, but it's a tower because it's got 4 stories, and in Tucson, that's a skyscraper. And anywhere else, it's a garden-style property, and so people get a chuckle out of that. But there's 90 units, primarily 2 and 3 bedroom units. They're large, they're over 1,000 square feet, so they're very large units. And a lot of them have a garden. The first level has courtyards, and the upstairs have balconies. And then the surrounding buildings, there's some units that surround the building as well, and those are all garden units, and some have both a front and a back entrance to parking lots. So it's much more like a home than it is like a standard apartment building. And compared to the other apartments in the area, they're actually, current rents are below market. So we could push to market, and then anything that has a courtyard, you could charge a premium and say, listen, if you want to live on ground floor with private parking, a private courtyard, front and back, this is the premium. Only backyard, this is the premium. Second floor, this is the premium. Third and fourth, get the standard rate rent that's published to be comparable with the market. Right now, the current owners haven't been doing that. They've been focusing more on infrastructure. The other thing we like is the tower itself is master chiller and heater system. A lot of operators don't care for those. We like those. We think they're very they're more efficient. We know they're more efficient. A master metered system is proven to be 30% more efficient than individual units. And when you have an issue, you can deal with it with one contract. Comes out, you have a contract for maintenance repair. They come out, they fix it, and it's really quick and easy for repairs. Whereas the AC units go out, they start going out, you know, every year, 2, 3, 4 units going out, sometimes 10 or 15. And that takes a lot of time, energy, and cost that people don't foresee. And the master meter controls are nice also as far as the residents go, that there's maximum heat and AC that, you know, that they can, or, you know, a floor for AC temp and a ceiling for heat temp, so that they run it efficiently, and people don't run their AC with their windows open. There's all these things that you can do. And the other thing I like about this property is it's got an opportunity to push it up into a nicer C. It's got great bones, as we say. It's got concrete walls, concrete ceilings and floors all the way up the tower. So it's a really durable building. A lot of the updates have been done to the plumbing and electrical. All the units are individually metered for electricity, for outlets and lights and microwave and refrigerator. So people do pay their own power for those parts of the utilities. And so a lot of that's already been done. What they haven't done is finalize that. They haven't turned the inside into a more of a model hallways, because all the hallways in the tower are inside. And you could really make those look nice, upgrade those, and provide a more of a home experience than a apartment experience, if you will.
So someone comes up to you, Bruce, and says, hey, this deal that you have down in Tucson is very interesting, but I'm curious, why are you holding it for 18 months and not just keeping it forever? What do you say? What's your response to that?
Well, we could actually keep it longer. The model works best in the 18 months, but the investors, if we have a collection of investors that are willing to stay in long term, once we get to that 18 months, we do have a buyout provision that's in the documents, and they'll be led to that part of the documents that said, hey, we have a right to buy out investors. And some of those investors might say, you know what, I want to stay in. We're in a part of the economy or the market or my personal situation where it would be good for me not to get the money back. Let's leave it in there. In fact, maybe they'll buy out some of the other investors, and we can put in some agency debt, some long-term financing, and hold it for 10-year cycle. That is on the table for discussion. But what we wanted to do is, we're really good at stabilizing the property and bringing it to market. So in our investor base has historically been 24 months or less. So that's where we focused on that. But we are going to shift, and we do have that buyout provision in there that we may end up keeping it.
Someone comes up and says, you know, I've never invested in multifamily, Bruce. I'm starting to see you on social media and places, and I like you as a person. I like your focus on the residents and the togetherment concept. But why, from the investor's perspective, if I've never invested in multifamily, what are some of the things that I could get by investing with you or another multifamily apartment investor? Why is it different than just putting my money into a REIT or a stock?
It's the investments in syndications typically pay higher returns. For investors to buy stock on the public market, to buy a REIT, to invest in other investments like that, to get 14 to 20% return on their money or double-digit returns year after year is not likely unless they're really active in their stock trading or their investing strategies. So the syndications historically have paid more. Now the returns are, because the cost of money is shrinking, the returns are also shrinking. There were a lot of syndications were getting 20 to 30% back after the crash, but money was very expensive. People were concerned. They were holding back. Now, as the supply of money increases into the marketplace, the cost of money goes down. You get higher leverage, different leverage, and a lower interest rate. That also affects the return. But we're still seeing double-digit returns across the board in syndications in the sub-markets that we're in.
Yeah, I think a lot of people are attracted to that because they may be too busy to invest in real estate and then manage it, find the deal, handle the toilets and all of that. So when they put their money over into a multifamily syndication, they're essentially relying on a team with a track record to handle all of that while they continue to do the things that they like, go out on a golf course or travel and do the things that are important to them. So that's a great concept as well about investing in multifamily syndication. Now, if people want to get on the phone with you, or if they want to reach out, what is the best way that they can get information about you or reach out to you?
Well, I really like the email is really a great way. Bruce@bakerson.com, Bakerson, son of a baker. So Bruce@bakerson.com. And if somebody wants to call or text, they're free to call me at 520-808-9111.
Yeah, let me ask you this. There's a lot of people that are in syndication. What do you think is different about Bakerson versus everybody else?
Our focus on the resident, we really care about the resident. We care about people. So the way I look at it is a lot of investors they say they care about the resident, but they don't really treat them that way. We know because we buy those properties and the people are mistreated. And I put it very simple: a $700 a month resident, a renter from you, a customer, after 5 years has paid $42,000. Don't you think they should be treated with respect just on that alone? Outside of just doing the right thing and treating a human correctly, but people don't treat them as customers. They treat them as something because they're lower income, that they're a lower class, that they're not worthy of time. And humans are humans. We treat everybody with respect, and they get the dignity they deserve.
What are some of the things that you do to a resident or for a resident that you see other syndicators or other operators not do?
We have with our property managers, we push for a short response time. We have our property managers and ourselves have been through multifamily safety training with the Phoenix PD and multi-housing for Phoenix PD and Tucson PD. We keep the areas clear from the dark spots. There's the lighting is good. So just those type of things are the best things. And in a very simple way, our mission is providing communities which are safe, functional, durable, and clean. And it's amazing how far that goes. That is a lot of operators don't go to that level.
So walk us through the impact that you see that has been made on some of the properties. You've taken these properties, they've been a little beat up with some bad residents, and then what have you done and how has the community responded about that?
Well, there's a couple of them. There's one that pop into mind. One of them was 22 residents in Glendale. There are 22 units in Glendale. It was vacant. It was boarded. It was shut down by the city. It was condemned by the city. It was in a lawsuit. It was a mess. It was a guy running pornography and prostitution out of there. It was really a nasty place. And my son found it. We were going to flip it, and I went and drove the property. I said, "Hey, this is one we can fix. We could do something here." And so we had to go to the city, and we found out that we bought it in I think it was February or March, and it was set for demolition in April. And so I went and sat down with the city neighborhood services and said, "Is this really what's the highest and best use for this property, and what's the best thing for the community?" They said, "Well, if that was run as an apartment, it'd be great." I said, "Tell you what, will you remove the condemnation? Will you cancel the demolition if we fix it up?" He said, "Sure." I said, "We're not going to get it fixed up in a month. It's going to take more than a month to do what we need to do." He said, "Tell you what, if you do this in month 1 and do this in month 2 and this in month 3, and building by building, we'll issue you permits and you can get occupancy." They waived some of the permits that were typically required regarding landscaping and other things because of how much we did there. When we got all done, the neighborhood services was shocked. They really didn't think we were going to do what we did with it. And you drive by there today and it looks really nice still to this day. So that was huge just from the city of Glendale itself. The second one is Pueblo Springs in Tucson. It's a 75 unit building. We're going to add a couple of units that are stores to be 77 when we get done. And that one there, the police officers asked us, "Why did you buy that property?" And then some months later, they stopped in to visit with the property manager and said, we're just really impressed with what you guys have done here. This was really a problem property with drugs and traffic and kind of a local drive-through pharmacy, if you will. And he said, "You guys have cleaned that all up, and I really appreciate what you've done. We're wondering, what you guys do different." And that was just a few months. It was pretty impressive.
What did you tell the policeman?
Well, he talked, yeah, I didn't talk to the police at that point. As a property manager, I talked. They just said that the gal that the manager just said, we just don't put up with it, that we just cleaned it up and sent them out. And a philosophy that I've adopted, I learned from some friends in Texas that are operators much grander scale than we are, but they buy properties that are condemned like that in Dallas area. And they said, if you clean up the trash, the rats will leave. And when you clean up a property, the problem people do eventually, they might kind of struggle or resist, but eventually they go away. They don't want the attention. They want to be anonymous in the community and control it, from behind the scenes. They don't want people to know who they are because it attracts the police and other city officials. So you start cleaning that up, they go away. They go find another place of less resistance.
Well, it's been a lot of fun, Bruce. I know that we have some things to do here. You got to get off the phone call in about 8 minutes. But I wanted to wrap up and say thank you so much for coming on. Hopefully we can get you back on, or some of your other family members. I know I'd love to have Ben on here, so I'll reach out to him. But thanks again so much, and I really appreciate the opportunity to dive deep into your mind and what's going on with your business. I think a lot of people appreciate that.
No, thank you. I love sharing it. It's a passion for me. As you can tell, I'm a passionate person. It's a lot of fun, and just making a difference in the community and having making a living off it is really special. And that's really what we enjoy at Bakerson. It's really been a fun journey, and we're looking forward to a bright future.
All right, very cool. Well, with that, we'll sign off. Thank you again for coming on the show. We'll talk to you soon, Bruce.
All right. Thanks, Ruben.